Let's get more from Rebecca Babin, Senior Energy Trader at CIBC Private Wealth. Rebecca, always great to see you. Thank you very much. You're listing some factors that look bullish for oil right now. Could you walk us through the one or two that are jumping out for you, please?
Sure. So I think the most bullish factor that's kind of transpired over the past couple of weeks and has been a driver of the recent rally has really been this concept around expanding sanctions for both Iranian and Russian vessels carrying sanctioned crude. Now, that in itself hasn't been a key driver for crude over the past, year. But what has been different this time is we're actually starting to see the buyers of sanctioned crude back away from those purchases in anticipation of Trump taking office and fears that they will be on the wrong side of buying the sanctioned crude and maybe face repercussions. Earlier this week, Shandong port said that they issued a statement saying that they wanted all of their members to start really being more conscious about buying Iranian barrels. This is the first time we've seen this in well over a year, this kind of rhetoric from China saying, we're not comfortable with what our ports are doing. We want you to be a lot more conscientious. And I think for a while, many traders have been questioning whether the sanctions that are going to potentially come under a Trump administration will transpire. And this was an indication that it might not be as much about enforcement, but more about the buyers of those sanctioned barrels taking a step back and no longer providing that kind of outlet. So that was one of the main factors I think drove the last 10% rally that we had, kind of from late December into early Jan. I think the other factor has been we've seen better OPEC plus compliance. The overproducers and the OPEC kind of group, specifically Kazakhstan, Iraq, Russia, have really started to dial it back. And that's given the market a little bit more confidence that the cohesion of the group and the way the group is going to respond to markets is stronger. That's a big fear for many traders, is that that group's cohesion isn't there and that they're going to come back and flood the market when they try to unwind their production cuts. So I think those are the two key factors that kind of turned sentiment slightly more bullish. Now, keep in mind, we came from a place where sentiment was extremely negative, positioning was short, and we've seen kind of those shorts cover and maybe pump the brakes on the bearishness. I like to say maybe the New Year's resolution for crude traders was to be less bearish. But like many resolutions, I think this might be a January effect, and we might see kind of that bearishness start to pervade back into the markets after the inauguration, when people start to focus on whether we're in a surplus for 2025.
What about this 200-day moving average for oil, roughly $75.48.50? Is that a very important benchmark right now? If oil fails to get above that, would it be bad news for the oil bulls?
I think it would. I think the more times we test and fail it, it kind of strengthens that resistance point. And the way I'm looking at it is we will need something distinctly positive in the fundamental backdrop to push us above that. I don't know if rhetoric or, dollar weakness or any of those things is really going to do it. I think we'd have to actually see a much better demand number come out of China, maybe following their Lunar New Year, which is up and coming, or some kind of significant supply disruption. Keep in mind, though, we are seeing some very, very cold weather, and there is an uptick in demand from heating oil and potentially some freeze off. So it's not that those things aren't impossible to happen, but I think to get above that 200-day, we need a catalyst. I just don't think sentiment alone or CTA flows is going to get us there.
What is your outlook for oil for the balance of 2025? Can you remind us, Rebecca?
Yeah, so I feel like we're going to be again in that a little bit of that range bound environment that we were in 2024, but the range is about $5 lower. So if we were 80 to 90 kind of in 2024, we might be kind of looking kind of 70 to 80. I think would be where I play it. I think when you get these really negative sentiment sell-offs and you kind of test the 65s, you can buy that dip. But above 80, I just start to think about that spare capacity that's on the sidelines from OPEC plus and the potential for maybe U.S. producers to increase production at those price points. And I think it's going to be really hard for us to sustain rallies above there. So I think you want to kind of trade your range range again. Don't get sucked into rhetoric rallies. Wait for data points. And when things get really oversold and everyone is talking about, how bearish it is, buy those dips. So I think the range works again this year. It's just a slightly different range.
And then, of course, this strong US dollar, maybe we could put up a 5-year chart for the Bloomberg dollar index. That mechanically will tend to keep oil prices down if the greenback stays strong.
Absolutely. It is a headwind, and it is certainly, I think, going to have a more pronounced effect as the year goes on. So we will want to see, I think that really caps rallies. We'll want to see how the dollar and how tariffs correspond with demand growth, right? So if demand can stay gangbusters and the dollar stronger, it will work out. But if in most cases, the stronger dollar starts to hit demand, and we will see it kind of really pump the brakes on any kind of rallies. So yes, worth watching. It's had a big move. And we'll see what happens from here. Lots of unknowns with what happens over the next couple of weeks with tariffs.
We've only about a minute left. Do you think the Saudis, as the crucial producer within OPEC Plus, are okay with the current price, or would they? I mean, obviously they would like longer-term higher prices, but are they generally happy with oil around almost $74?
I don't think they are thrilled with this price. I think 80 is kind of the price point where they're most kind of satisfied, and they feel like consumers aren't getting killed and producers aren't, miserable. I think down here, I think they're going to continue to try to get it back to 80. That would be my sense. If that means they have to hold off bringing back production for longer, like they did in December, I think they will try to do so. So it's not a disaster, but I think they will continue to take action to try to get closer to 80, in my view.
Rebecca.